Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I want to talk about retirement income planning in 2022. We've had a lot of questions come into the financial planning firm here recently about how we're thinking about drawing income from our savings, from our assets, amid rising interest rates and stock market volatility. Specifically, we hear a lot about Roth IRA conversions and long-term capital gains harvesting. And then we have these additional complications like, when should we file for Social Security? What's the tax impact of that going to be? What's the cash flow impact of that going to be? And ACA premium surcharges. The amount that we pay for Medicare Part B premiums depends on your income. So if you take money out of a 401k or IRA, that's counted as income. It could impact the amount you pay for Medicare. Same goes for if you convert money from a traditional IRA or 401k to a Roth account. It could mean that you're paying a little bit more for Medicare a couple years down the road. So today on the podcast, I want to talk through all these things and how we view retirement income planning in today's day and age based on your objectives, what you're trying to do with your resources, and how much you care about paying tax. A lot of people try to minimize the amount that they're paying to state and federal tax authorities over their lifetime, and there's a way to optimize for that. And so we talk about that framework and how we think about it here at the financial planning firm in today's podcast, and I hope you enjoy it. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. This week on the podcast, I want to refresh a topic that we've talked about quite a bit on the show over the years, but it's been a little while since we've talked about the guts and the details of retirement income planning, specifically in 2022 when bond yields are going up. That's temporarily depressing bond prices. Stock markets are sputtering a little bit, to say the least, thus far in 2022. And we're getting a lot of questions from listeners and readers and just people in general about how we need to think about all this. And to kind of set the landscape for what I mean by that, these days, Americans are predominantly saving for their retirement using tax-advantaged investment accounts. Predominantly 401k plans is the most common mechanism people are using to save for their own retirement. And that's by and large a good thing. You know, the reason that we have 401k plans in the country in the first place is that the government wants us to save for our own retirement. That's good for everybody when retirees have enough money saved up to where they can continue to pay their living expenses without having to work until the day that they die. It's good for the economy. It's good for our citizens. It's just good for our country in general. And so they offer us a nifty tax advantage, Section 401k of the Internal Revenue Code, to incentivize businesses to offer these the tax-advantaged retirement savings vehicles to their employees. And so, as you all have noticed over the years, 401k plans are defined contribution plans, meaning that the employee puts money in, and the amount that you can contribute is defined by the IRS. There's a limit as far as how much we can put in every single year. And over the years, I'm sure you've noticed that 401k plans are a lot more common and company pension plans are a lot less common. And that's because when you have a pension plan, the company bears the responsibility of the investment risk. You have employees that work for you. You are guaranteeing them a stream of income in retirement after they stop working. That's a liability on the balance sheet of the company, and corporate executives have, by and large, kind of gotten away from that. And so that means that we're on our own when it comes for saving towards our own retirement. And that can be a good thing. It can be kind of a dangerous and scary thing too. And as it relates to retirement income planning, it has a lot of, I think, important ramifications that we need to be aware of. And so here's my point is more and more of us around the country are saving for our retirements using 401k plans. Generally, when you put dollars into a 401k plan, you're deferring them from your paycheck, meaning that you don't pay income tax on the money now, which is great. But down the road, when you pull money out of those accounts, either through the 401k or through an IRA, if maybe you've rolled it over, that money is going to come out as taxable income. And it's really convenient while you're working, right? Because if you think that you're making more money during your career than you'll make after you stop working in retirement, which is probably true, is true for most people, then you want that tax deferral during your peak earnings years, because we have this progressive tax system where the more money that you make, the higher the rate of tax that you pay on it. We have tax brackets right now that are 10%, 12%, 22, 24, 32, 35, and 37%. And the more money that you make, the higher bracket that you find yourself in. And if you're in your peak earnings years, in your 40s and 50s, maybe your early 60s, well, that tax deferral is really nice, because those are the years you're going to be in a higher tax bracket by virtue of making more money. You can put money into the company 401k plan and defer the income until a later date. So you shovel money into the 401k. You don't pay tax on it when you happen to be in a high bracket because you're making a lot of money. And you take money out of the 401k at a later date when presumably you're not working anymore. You're probably making less money and are therefore in a lower tax bracket. So it's a really powerful way to save for retirement. That's why financial people like me like to espouse the benefits of 401k plans over and over and over again. It's a great tax advantage. Once you put the money in, it grows tax deferred. You don't pay tax on gains or dividends or interest or anything while it's in the account. You only pay tax on it when it comes out of the account later on. And the contribution limits are a lot larger than most other plans that we have available to us. Small businesses might use SEP IRAs or simple IRAs. Your limits are a lot different than they are in a 401k. Your individual IRAs are limited to $6,000 a year of contributions, $7,000 if you're over the age of 50. And so 401k plans are better than that, because as an employee, this year you can put in $20,500 as an employee. You can put in an additional $6,000 on top of that if you're over the age of 50. And your employer can put in money up to $58,000 total between your contributions and their contributions this year, plus the extra $6,000 if you're over 50. So you can park a lot of money in these plans. And the reason that I wanted to talk about this subject in particular today is that more and more of us are putting money into 401k plans. We're relying on that asset base to pay our living expenses after we stop working in retirement. But when and how you take money out of that 401k plan after you stop working has a lot of ramifications with regard to your taxation. And there are some maneuvers that you might consider after you stop working that can really reduce the ultimate amount you will be taxed over the rest of your life. And so here's a couple things to think about just to get us started. So more and more of us have most of our nest eggs sitting in tax-deferred retirement plans like 401ks. Let's say that you're working somewhere, you've had a nice career at a big corporation, you've been there for 20 or 30 years, maybe you've bounced around corporations a little bit. Now you've just turned 65 and it's time to step into retirement. What a lot of people elect to do when they step into retirement and leave the company is roll their 401k plan assets into an IRA. You don't have to do that, but a lot of people choose to. And the primary reason is that when you have the money in an IRA, you can invest in whatever you want. You have total discretion over whatever the brokerage account holding, custodying the funds will allow you to invest in, you can put in that IRA. And so, because after you leave your company, you're able to roll assets out of a 401k into an IRA without tax impact whatsoever. And because you have more discretion once the assets are in an IRA, that's what most people elect to do. Again, you can leave them in the company 401k plan if you want. You're not obligated to move things around. But I think most people, by and large, decide to go the IRA rollover route. Once the funds are in the IRA, now remember you're 65, you've stopped working, your income is probably going to be lower. And number one, when we think about retirement income planning, we need to cover our expenses from somewhere, right? And so if you're spending, let's say, $10,000 a month on the mortgage and groceries and travel and all the other stuff, golfing or whatever that you plan to do in retirement, well, we have to find that money somewhere to pay your living expenses. And so to get us started here, when I think about retirement income planning, I think about this hierarchy with which we want to distribute from accounts. Because you might have assets in the 401k or IRA, you might have cash in the bank, you might have a taxable investment account, you might have a Roth IRA or maybe a Roth 401k feature. So when it comes to taking money out of your accounts to pay $10,000 a month for your living expenses, well, where do you pull it from? Generally, what we want to do is pull from taxable investment accounts first, because the tax advantaged and tax exempt accounts, tax advantaged meaning 401ks, IRAs, tax exempt meaning Roth IRAs, because you take money out of those accounts, you don't get taxed on them at all. Generally, what we want to do is distribute from taxable accounts first, because we want to preserve the tax benefits of those 401ks, IRAs, and Roth IRAs as long as we can. So we don't want to take money out unless we have to of those accounts. We want to allow the assets to grow and compound on our behalf long term. And we only take money out of those accounts when we have to, or when our taxable investments have been depleted. So if you're someone who has, let's say, $500,000 in a taxable investment account and $500,000 in a traditional IRA and another $500,000 in a Roth IRA, well, if you're 65 and you just retired, generally you would probably want to sell assets in the taxable account, maybe in your name or you and your spouse's name jointly, or in the name of your living trust perhaps. Draw the $10,000 a month out of that account, because that enables you to keep the other $500,000 in the IRA and the $500,000 in the Roth IRA to grow and compound tax deferred for a few more years. Now, as far as how much cash we want to keep on hand, I like to have some short-term cash sitting either in the brokerage account or the bank. Generally, it's 6 to 12 months worth of expenses, just so that you don't have to sell securities out of the taxable account if the markets fall drastically in value. In general, we're trying to buy low and sell high. And if you have a little bit of extra cash in the bank to provide some runway, that gives you the ability to wait out a temporary downturn in the market and sell at higher prices, which is kind of helpful long term. So let's say you're 64, you're in a high tax bracket. All the money that you're making from work is being deferred either into your 401k or it's coming into your bank account. The money that you're earning from work is what's used to pay living expenses. And then you turn 65 and you stop working. You're probably enrolling in Medicare at that point. You've got the same $10,000 a month of expenses. And to pay those expenses, generally we want to pull from the taxable accounts first, being cognizant of capital gains ramifications if you sell investments. Because if you have the $500,000 in your taxable account and they're all in mutual funds that are up 50% over the last couple of years, well, selling them means you're going to realize a capital gain. And so we want to be conscious of that when selling $10,000 a month of stuff in the taxable account to raise $10,000 of cash that you can pull into your bank account and pay your mortgage and your credit card bill every month. So that's number one. We usually want to use the taxable account first. Once the taxable account has been depleted, then we want to go to the tax deferred accounts next. The Roth IRAs are an awesome tax benefit. You never have to take money out of the accounts if you don't want to. It grows tax-free forever. If you do take money out, it comes out tax-free. If you die and bequeath that account to your kids or another beneficiary, they do have an obligation to take money out of the account over the following 10 years in most circumstances, but they don't pay tax on the distribution either. So it's an excellent tax vehicle, and we want to generally not take money out of it and preserve that benefit as long as we can. So let's say that you know something came up and you worked through your $500,000 in the taxable account, in the first couple of years. Well, now you have the money in the IRA and the Roth IRA. You probably want to start taking money out of the IRA, preserving the assets in the Roth. Once those have been depleted, that's when you touch the Roth IRA assets. Now, there is something we need to be aware of, though, because whereas you might take money out of the taxable account, yes, it could trigger some capital gains depending on what the return history of those positions looks like. But if you take money out of the IRA, the traditional IRA or 401k plan, every penny that comes out is counted as taxable income. And so we need to be cognizant of that, because if you have all your savings in the company 401k plan and you need to take out $10,000 a month to pay for your expenses, well, you're going to be triggering $120,000 worth of taxable income every year to pay those expenses. And we need to be cognizant of that when thinking about long-term taxation, which I'll get to in just a moment. So on the one hand, we have to pay our living expenses. And generally, we want to do that by distributing from taxable accounts first, deferred accounts second, and exempt accounts last. On top of that, we have this progressive tax system where you're probably in a higher tax bracket while you're working and earning an income. After you stop working, you might fall into a lower tax bracket, especially if you're pulling from taxable accounts where every dollar that you raise in cash is not going to trigger a dollar in taxable income, whereas it would with distribution from an IRA. And we have this gap between, in our example, let's say 65 is a retirement age, and when you have to start taking money out of these IRAs and 401ks as well. So the less money that you make, the lower tax bracket you're going to be in. The more money that you make, the higher the bracket you're going to be in. And remember that because we've deferred money that's gone into the company 401k plan while we're working, we've not paid the IRS on that money at all. And that's where these pesky mandatory distributions come into play once we turn 72, because the IRS hasn't collected anything off the $500,000 you might have in the 401k or IRA. They're waiting around for their cut of that money. The Roth IRA, you've already paid taxes on when you contributed to the account in the first place. That's why we don't have RMDs, mandatory distributions from a Roth IRA. We never have to take money out of that account because the IRS has already gotten its share of that loot. They haven't gotten their share of the traditional IRA or 401k assets yet. So once we turn 72, we're forced to start taking distributions out of these accounts. And mathematically, in the year that you turn 72, you take the account balance on December 31st of the previous year and divide it by your life expectancy that's provided by an actuarial number that the IRS gives us. There's this actuarial table. You can look it up online if you're interested. And in the first year, the year that you turn 72, I think it's 26.4 or 26.7, if I recall. So you take the account balance and you divide it by your life expectancy. And then the next year, you're 73, you take the account balance of December 31st of the previous year, the year in which you turned 72, and divide it by your life expectancy at 73. And the reason that's important is because you're 1 year older, your life expectancy's gone down by about 1 year. And if you have a smaller denominator every single year, you have to distribute a greater and greater portion of the account every year that you get older. And this is why this retirement income planning that I wanted to focus on the podcast this week is so important. Because think of it this way. If you retire at 65 and we're planning until, maybe age 95 or 100, let's call it an even 30 years. We're planning for a 30-year retirement just to cover our bases. What generally happens, because and we've gone through this hundreds of times in the financial planning firm, but because so many of us are saving for our retirement using tax-deferred 401k plans, the amount that we have to distribute once we turn 72 and thereafter becomes a very, very large number. And because all of those distributions are taxable income, it actually kicks us up into a higher tax bracket, sometimes 32, 35, 37%, circumstances depending. So if you're somebody who has a couple $1 million in your 401k plan, you should know that when you turn 72, you're going to have to start taking money out of that plan, as provided you're not still working at the company at age 72. If you are, that's a temporary exemption. And every year you get older, you have to take out a larger and larger portion. So when you're 65, back to our example, when you're 65, you're in a high bracket. When you stop working, if you're 64 and before you're working still, you're in a high bracket. You stop working at 65, you fall into a lower bracket. And then you have this window between 65 and age 72 before you have to start taking money out of those tax-deferred plans. And that being the case, usually you create more income through those distributions and you find yourself in a higher tax bracket at age 72 and thereafter. And because of the way the math works, if we're mapping out, think of it as like a graph over a 30-year time period. Age 65, your income is lower. At age 72, it really spikes because you have to start taking money out. But every year thereafter, often what we see is the growth in these IRAs and 401k plans is greater than the distributions coming out. And so between the growth of the account and the fact that you have to take more and more out of the account every single year, your income goes higher and higher and higher and higher and kind of hockey sticks up into your 80s and 90s, which kicks you into a very high tax bracket. So this is an issue for a lot of people because many of us want to plan for our retirements and take distributions from our accounts in a manner that's going to minimize the total amount of tax that we have to pay to our federal and state authorities. The government is our business partner, whether we like it or not, but we don't need to leave them a tip at the end of the day. It's our right to plan around this and try to minimize the amount that we're paying as long as it's within the rules that they give us. And one way to do it is to fill up your taxable income in the years in which your income falls and you're in a lower bracket. So think of it this way. If you're in the 35% bracket while you're working, you stop working at 65, you have 7 years until you have to start distributing from your IRA and 401k. And let's say that in those first couple of years after you stop working, you fall into the 12 or the 22% tax bracket. Well, that's pretty handy to know because you might find yourself in, the 32% tax bracket after you turn 72 because you have to start taking money out of those accounts. So one thing that we always want to look at when you're in those lower bracket years is, number one, are there long-term capital gains you might be able to harvest at the 0% threshold? And I'll get to that in a moment. Or should we take some of the money in your tax-deferred IRA or 401k and shovel it into your Roth IRA? Because when you do that, you trigger taxable income in the year where your income is lower. And it could be the difference between paying tax then at 12% or 22 or 24%, or waiting until after you have to start taking the money out when you're in your 70s and paying 24, 32, 35, 37% on it then. And so it's a trade-off. You can pay less tax earlier when you don't have to, or you can kick the can down the road and pay more tax later. But it has a whole bunch of benefits by using these gap years between 65 and 72 to your benefit, because you're in a lower bracket then. Any money that you use to move over to the Roth, and this is called a Roth conversion, by the way. Mechanically, you take assets, you move them directly from your traditional IRA into your Roth IRA. Your broker produces a 1099. As long as it doesn't come out and you deposit it in your bank account or anything like that, it's not a distribution, it's a conversion. And that's important because there are no limits to the amount of Roth IRA conversions that you do every single year. So by doing this, you're paying tax when you don't otherwise have to, but you're doing it strategically at potentially a lower rate. And you're shrinking the pool that's subject to those mandatory distributions in the future. So let's go back to our example. You've got $500,000 in an IRA, $500,000 in a Roth IRA. Well, let's say you took $50,000 in 1 year. And the reason we might say 50,000 is that maybe you do a tax projection, you figure out that you've got $50,000 of window before you jump from the 24% bracket to the 32% bracket. That's the amount of room that you have between the two. And if you don't do anything, you'll be in the 24% bracket this year, but after mandatory distributions kick in your 70s and 80s, you'll find yourself in the 32% bracket later and higher. Well, if you have $50,000 until you reach the 32% tax bracket, you could convert that by taking $50,000 in your IRA and moving it to your Roth IRA. If you have $50,000 of room left in the 24% bracket, that means you're going to be paying 24% federal tax on that $50,000. You don't otherwise have to pay that tax that year, but you could move it to the Roth. And by doing that, the balance in your traditional IRA that's subject to those RMDs is shrinking from $500,000 to $450,000, which has a lot of benefits down the road. You're shrinking the pool of assets subject to those mandatory distributions when you're 70 and 80 and 90 and have to distribute a larger and larger portion every year. And you're adding $50,000 to the pool that's exempt from taxation for the rest of your life. You never have to take distributions from the Roth IRA if you don't need to. If you do, it comes out tax-free at that point, and it's a huge tax-saving strategy. Something else you might want to think about in your gap years, this period between 65 and 72, is that we have a 0% long-term capital gains bracket. And as you might know, so using our example, we've got $500,000 in a taxable investment account too. If you bought shares of Apple, 5 years ago at 100 and now it's trading at 200, and you sold them, you would have a long-term capital gain you have to pay tax on of $100 per share. And it's considered long-term because you've held the shares for more than 1 year. If you held the shares for less than 1 year and you sold them, it's a short-term capital gain. And you pay tax on that at your rate of ordinary income, which could be 24 or 32%, maybe 35 if you're still working, circumstances depending. But if once you hold the investment for longer than a year, long-term capital gains rates apply. And the rates are 20% if you're a higher income earner, 15% below that, and 0% if you make less than, I think it's 87,000 or something this year. And so if you're someone who's just retired from your job, you might be able to harvest some taxable capital gains and not pay any tax on that sale at all because you're in the 0% bracket. Usually we find that it's for people in this situation, it's more effective to use this room left in your tax brackets for Roth conversions than it is for long-term capital gains harvesting, but it is a tool in our toolbox that we need to be aware of. Now, just as a side note, we're talking about paying tax in years where our income is lower. The downside of doing that is you're paying tax now when you don't otherwise have to. And if you don't live until you're 72, you're not going to realize the benefits of that in your lifetime. Your beneficiaries will, but not you. And so if you don't think for any reason that you're going to live beyond age 70, well, it's usually better to kick that tax can down the road and defer so that you don't have to worry about it. Right? That's the downside of doing this, is you're paying tax now when you don't otherwise have to. And the benefits don't come until you're in your 70s, 80s, and 90s yourself. That being said, if you make it into your 90s, the juice is absolutely worth the squeeze. And we've quantified this for a bunch of people over the years that we've recommended this to, and the total tax savings that you can realize over your lifetime can sometimes be as high as in the seven figures, because you're paying tax now when you don't otherwise have to, but at a lower rate, and getting that money into a tax exempt account so it can grow tax free for the rest of your life if you decide not to take it out, as opposed to kicking the can down the road, letting the assets grow, and then having to take more money out of that account, all of which will be considered taxable income. So the way this works is that the benefits are back end loaded, but the benefits are very substantial. And if you make it that long, at least into your early 80s, there's going to be tremendous benefit by doing that thoughtfully. Now, there are other things we need to consider, though. That's kind of the basic framework of the more money that we make, the more rate of tax that we pay. And if you find yourself after you stop working in a lower tax bracket, we want to fill up those lower tax brackets in years where you're there by shoveling money into the Roth accounts or harvesting gains. Now, when you do that, there's this other thing that we need to be cognizant of, and that's ACA healthcare premium surcharges. ACA standing for the Affordable Care Act. When, back to our example, if you're 65 and you're retiring, chances are you're probably going to be enrolling in Medicare. The amount that you pay for Medicare Part B depends on your income, specifically your modified adjusted gross income. So if we're accelerating tax between the age of 65 and 72 because it's going to be beneficial to you long term, if we accelerate too much and go beyond a certain threshold, you're going to have to pay more for your Medicare Part B. And I've got the thresholds here in front of me. In 2022, the standard Medicare Part B premium is $170.10 per month. But if you're a married person filing jointly and your modified adjusted gross income is above $182,000 this year, then you're going to be paying $238.10 per month in premiums 2 years down the road. And I'll get to why it's 2 years in just a moment. So the more money that you make, the more that we accelerate income and pay tax now, the more likely it is that it's going to impact your Medicare premiums down the road. And so we're trying to play this balancing act of how much income do we want to accelerate? Because if you're not going to make it to age 70 in the first place, then just defer. Don't pay any tax now because you don't need to, right? But if you do, it's going to benefit you down the road. So do you want to pay tax now or do you want to pay tax later? I see these Medicare premium surcharges not as really a different beast that we need to tame, but more so as just an additional layer of tax. And if we're trying to balance the scales, one way to do it might be, let's expect that you live all the way to age 95. How do we smooth out the income that you have over the next 30 years in a way that minimizes the total amount you're going to have to pay to state and federal tax authorities over the next 30 years, over the rest of your life? And the way that we do that is by filling up the lower tax brackets whenever we can. Now, when we've gone through exercises like this in the past with clients and we actually quantify it, The variables are very clearly, well, how much do you have in the 401k or IRA that's going to have to come out through RMDs in the first place? What are your expenses? What bracket do we think you're going to be in any given year? But generally, the way that it works out is, even though triggering income beyond thresholds, which might make us pay a little bit extra for our Medicare premiums a couple years down the road, even though we might pay more for our Medicare premiums, the benefit of doing those conversions is far greater than the extra amount we're going to have to pay now. I just consider it a little bit of extra tax, which is really what it is. But if you live into your 90s, the benefits of doing the conversion and blowing through those thresholds, paying a little bit more for Medicare in the meantime, the benefits greatly outweigh that extra layer of tax. Again, if you only make it to 75, that's probably not going to be the case. Your beneficiaries of your Roth accounts will still benefit from it, but it's a balancing act that's a little bit different for everybody, and it's different depending on the goals and the objectives that everybody has. Now, why is it 2 years down the road? Well, remember how we file our tax returns every year. We have all these taxable events throughout the year. Like, we earn our paycheck, that's a taxable event. We do a Roth conversion, that's a taxable event. We take out money from our retirement accounts, that's a taxable event, whether we have to or not. And then we add it up. We add up all those transactions from January 1st to December 31st. And then we have a few months to get all our 1099s and all our information in the mail. And we have to file our returns by April 15th. So we have between January or December 31st and April 15th to file our returns, compile all our information. But you pay the new Medicare premium starting on January 1st. So the Social Security Administration, Medicare, doesn't know what to charge you for your premium in that year yet because you haven't filed your returns. That's why there's a 1-year lag behind when you file your return and when that modified adjusted gross income applies to your Medicare premium. So that's why I say 2 years down the road. If you do a Roth conversion in these gap years between 65 and 72, and your total income is above $182,000, it's going to impact your Medicare premium, not the next year, the year after that. So the government has an opportunity to take all the numbers and assign you your premium. So those are really the variables. And the only thing that we haven't covered that's relevant is Social Security. Social Security is another form of taxable income. You can claim it as early as 62, as early as 60 if you're a widow or a widower. And you can defer and collect delayed retirement credits and boost the value of the monthly check that you're going to get once you do file. You can delay all the way up to age 70. So how do we put these pieces together with the Social Security angle included, right? The way that I generally like to think of it is, what are we really trying to accomplish here? Are we trying to balance the last check that we write? Are we trying to maximize a bequest to our kids or charity or somebody else? How long do you think you're going to live? What's your health? How important is it to you to minimize taxation? Those are the variables that we start with. And once you understand what you're really trying to accomplish, the decision-making becomes a lot more logical. If indeed you're someone who's trying to minimize the total amount of tax that you're going to pay and you're relatively healthy, you think you're going to live at least into your mid-80s, it's generally most beneficial to take out to minimize your income between when you stop working and age 70, aggressively use those years to convert your tax deferred assets to Roth accounts, knowing that it will probably impact your Medicare premiums in some way, shape, or form. Then when you're 70, you file for Social Security, adjust your Roth conversions in those years, because if you have Social Security benefits coming in, that's going to impact your taxable income. If you had $50,000 of room up until the next tax bracket before Social Security, you're going to have less than $50,000 left of room after you have the Social Security checks coming in. And go from there, because that maximizes the value of that window It defers your Social Security benefits as long as you possibly can and helps you capture the maximum benefit of these Roth conversions that we're talking about. Now, the way the math works on the Social Security is every year after your full retirement age that you delay collecting benefits, your benefits go up by 8%. So it's a guaranteed 8% increase on the amount of those checks every day or every year that you defer after your full retirement age. And if you're someone that has an asset base where you don't necessarily need the income, then that can make a lot of sense. Now, if you only, again, if you only make it to age 75 before you kick the bucket, then you probably want to file for Social Security as early as you possibly can and collect as many checks as you can before you pass. But the way the math works here is if you live beyond your early 80s, so if you're going to live to at least age 83, you maximize the present value of those benefits by deferring to age 70. And most people in reasonable health in their mid-60s have a life expectancy of it's probably around 80, I would guess, based on the actuarial numbers. So those are the variables. Everybody's retirement income plan is going to look a little bit different based on your circumstances, your objectives, of course. And the starting place is always going to be what does your expense profile look like? What do you want to spend money on? What's important to you? What are you trying to do with your resources long term? And then the decision of when to file for Social Security, which accounts to distribute from, how much to distribute, whether to do these Roth conversions, all kind of fall into place after that. But it needs to revolve around your cash flow needs, and it needs to have a strong chance of success too. It needs to be a viable plan to where you're not using all the money that you have saved up in the first couple of years. We don't want to be destitute when we get older. That's of course important too. And there are a number of ways to stress test the retirement plan, make sure that that's going to be the case. But that's the general framework. We haven't. I went off on a couple tangents today, but it's been a while since we've talked about this framework. And for most people, the idea is I want to maximize the value of my savings. I've worked hard for these savings. I don't want to fork over any more than I absolutely need to the government. I want to plan to minimize our taxation and enable my spouse and my family and me to enjoy the money that I've worked so hard to save in these accounts. And usually that's the way that we do it. We want to figure out how to minimize taxation by forecasting your taxable income over a long period of time, understand the impact of those mandatory distributions because it's usually larger than I think most people realize, and then maybe shovel money from the IRA or 401k to the Roth account when your income is lower and you're in a lower bracket, even if it means paying a little bit more for Medicare a couple of years down the road. And then as far as timing the Social Security, that kind of depends on how where you have your assets saved. If you need the Social Security benefits for cash flow purposes and you're okay foregoing the delayed retirement credits, maybe you don't have a whole lot of assets in taxable accounts, you want to postpone taking money out of your tax-deferred accounts, well, that's a pretty good reason to file for Social Security at your full retirement age or maybe right after you stop working. But again, the circumstances for everybody are a little bit different. Okay, I think that pretty much covers it. We went over a lot of stuff today. I hope you hung around despite all my rambling. But I think the moral of the story here is there are not too many situations where you want to pull out of your Roth and tax-deferred accounts first. After you stop working and it comes time to take money out of your savings to pay your living expenses, almost always we want to distribute from taxable brokerage account, taxable investment accounts first, and then tax-deferred accounts, traditional 401ks, traditional IRAs, SEP IRAs, simple IRAs, things of that nature. We want to distribute from our Roth accounts absolutely last. We want to allow those to grow and compound as long as we can, because mathematically that's the way to pay the least amount in tax over the rest of your life. Okay, hope this was helpful. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.